Welcome to D-Risk Investing. This week we're tackling one of the most polarizing stocks on the market, Carvana. After nearly collapsing, the stock has staged a monumental comeback, capped by the recent news that it will be joining the S&P 500. The big question for investors now is, what is Carvana today? Is this a durable, high-growth compounder that has earned its new blue-chip status? Or is it a speculative turnaround play whose valuation has gotten dangerously ahead of its fundamentals?
Sarah, the tension is perfectly captured by the numbers. The market closed the week with Carvana trading at nearly $400 a share. Our discounted cash flow model, which is based on the fundamentals, puts its fair value closer to $110. That's not a small gap. The stock is trading at almost 4 times our intrinsic estimate. The discrepancy is clear. Our model is still heavily weighing the company's history of debt and cash burn, while the market is pricing in a flawless execution of the growth story, amplified by the forced buying that will come from S&P 500 index funds.
So let's dig into that fundamental story. The macro environment is tricky. We're hearing talk of a growth recession, which typically spells trouble for large consumer purchases like automobiles. Yet, industry data shows used car prices are hitting 2-year highs due to tight supply. This puts Carvana in a unique position. How is the company's actual performance engine running against this backdrop?
The engine is running surprisingly hot. This isn't just a story of survival, it's a story of efficiency. Revenue growth is accelerating again, but the number that matters is gross margin. It has expanded from a meager 9% in 2022 to over 20% today. That's massive operating leverage. Now, for the fuel. 2 years ago, Carvana's balance sheet was an anchor, weighed down by nearly $9 billion in debt. Today, they've cut that debt down to around $5.5 billion and built a war chest of over $2 billion in cash. They've fundamentally transformed their financial health. The one red flag I see is dilution. The share count continues to climb, which means existing shareholders own a smaller piece of the pie, a detail the market seems to be ignoring, for now.
That operational turnaround is impressive, Alex, but a $400 stock price demands more than just improvement. It demands market leadership. So the critical question is this. Is Carvana trading at such an extreme premium because it's a genuinely higher quality business than its peers? Or is this simply a case of speculative momentum leaving fundamentals in the dust?
The evidence suggests it's almost entirely momentum. When you line Carvana up against its peers, the valuation disconnect is staggering. Carvana trades at a forward PE of 170. The next most expensive competitor is at 18. It's not even in the same universe. Now let's look at the chart, which tells the story of that momentum. The technicals are flashing green across the board. The trend cluster, looking at things like the 50-day and 200-day moving averages, shows a powerful established uptrend. The momentum cluster, with indicators like the MACD and RSI, confirms this with accelerating buying pressure. Visually, the chart looks like a rocket ship that has cleared the launch tower and is heading into blue skies. The only caution is a slight divergence in the Chaikin money flow, which suggests some institutional selling under the surface, but for now it's being overwhelmed by the bullish force.
That paints a picture of a massive divergence. On one hand, you have fundamentals that, while improving, don't justify a 170 times forward PE. On the other, you have a technical picture that looks almost perfect. This brings us to sentiment. Analyst ratings have turned overwhelmingly bullish, with over 70% now recommending a buy. Yet, short interest remains elevated at over 9% of the float. So, Alex, who is right? The Wall Street analysts selling the growth story, or the professional traders betting real money that this rally is unsustainable?
That's the battlefield right now. The 9% short interest is significant. It represents a large pool of traders who are fundamentally bearish, but it also represents rocket fuel for a potential short squeeze if the price continues to climb. The options market gives us a more nuanced picture. The put-to-call ratio is just under 1, which is fairly balanced, not euphoric.
The key psychology is visible in the strike prices. For weeks, traders were buying calls stacked at the $385 level, seeing it as a ceiling. Now that we've broken through it, the biggest concentration of puts is sitting down at the $365 level. That's the market's new line in the sand, the point where traders are placing their defensive bets.
So, let's bring it all together for a final verdict. Carvana is a classic high-momentum turnaround. The operational improvements in margins and the balance sheet are undeniable and genuinely impressive. Management has successfully navigated the company from the brink. However, the current valuation has become completely detached from those fundamentals. The stock is no longer trading on its performance, but on the narrative of S&P 500 inclusion and pure momentum.
Exactly. The bull thesis relies on that S&P inclusion, forcing billions in passive inflows, squeezing the shorts, and the company continuing to execute flawlessly on margin expansion. The risk to the thesis is that any macro shock to consumer demand or a single bad quarter could shatter the momentum narrative, causing this valuation to collapse back toward reality. For those looking to trade this, the execution is critical. The upside target is open-ended, but a measured move from the recent consolidation points towards the $440 to $450 zone. The invalidation level is much clearer. A weekly close below $365, where the options market has drawn its line in the sand, would signal that this breakout has failed and the powerful momentum has been broken.
That's all for this week's deep dive. Thank you for your time, and remember that this podcast is for informational purposes only and not financial advice. All investment decisions should be made with the help of a qualified professional.